I am delighted to be here, as I'm sure all of you are and still are. I really enjoyed all the sessions today. You guys enjoy all the sessions so far? How's everybody's energy level? Woohoo! Okay, all right. So I'm going to do a little bit of, maybe make you thinking a little bit about some numbers. But what I'm going to talk about today is why both high growth and high profit is actually pretty elusive in subscription business models. So I'd be interested to see a show of hands. How many of you are working at companies that have subscription business models? That looks to be about 70% at least. How many of you are with companies that are, I'll call it, born in the cloud versus perhaps some that are more traditional and maybe moving to born in the cloud? How many born in the cloud? 30% maybe? And how many of you are with companies that are, let's say, older than 10, 15 years? Okay, the vast majority. Okay, so that's some good backdrop. So as was introduced, I work with TSIA, Technology and Services Industry Association. We are a for-profit research and advisory firm, and our exclusive focus is the technology industry. And my focus, as was mentioned as well, I lead the research practice for what we call X as a service product management. X being anything. So it could be infrastructure as a service, marketing as a service, platform as a service, literally anything as a service. XaaS obviously is the big one. And working with a significant number of companies that are pivoting from a traditional business model to as a service. So, and everything that we look at in terms of these product management practices are all kind of in the context of how do you be successful and what are the practices, the KPIs, the attributes of your solution, et cetera, that are really going to make for success there. And success being deemed as growth and profit. Okay, scale. So I have been very fortunate to have had what I consider a pretty epic career when it comes to product. I started out, I graduated here from Dublin, and then I went straight to California, and got the startup bug pretty early, and then became a startup junkie. So I kept going back to early stage companies only to get acquired by larger companies, and then back again to early stage companies to get acquired again. But have developed some really amazing products and been part of some really fabulous product teams. So a little bit about TSIA, as I mentioned, we are very, we'll say, data-driven, data-advised, as I'm hearing some former speaker use that term. So we take a lot of data, right? We really look deep at the business practices across all of the companies that we work with. And not just sort of doing superficial surveys, but really, really going deep into what are the day-to-day practices that are used, what are the attributes of the lifecycle management process, what are the attributes of the offers and the pricing methods, et cetera, that companies are using. And you know, our company has put a lot of books out into the market. We've got a global footprint, and we're very fortunate to have the who's who in the technology industry as our clients. So I thought I'd start with a controversial statement. It's 2020, and at the end of the day, nobody cares about your product really, right? I mean, they care to the extent that it helps them achieve something. It helps them achieve an outcome. One of the speakers just before this talking a lot about outcomes and how to orient towards achieving that outcome. And that's ultimately it at the end of the day. I mean, if you're maybe an early adopter, you might be very wooed by the technology itself. But if you really are a business and you're taking on some technology on board, at the end of the day, there's going to be an ROI calculation on what it's going to do for me, what it's going to do for my business, and why do I really care? So the demand for outcomes is there. Customers, prospects are talking that language. They're talking that language all of the time. And vendors, most of us in the room here, we're responding. I mean, you just have to do a Google search on that, and you'll get a ton of different companies' website talking about outcomes, even talking about outcomes as a service, which is actually a rare practice in the industry. But everybody talks about it. It sounds good, right? But bottom line is the focus is really on delivering values and outcomes and not just about technology for technology's sake. And you'll hear me use some terms. I'll tend to use the word sometimes technology and product as synonymous, and then service being providing that as a service. But first what I want to do is take you into the data a little bit to show you and to illustrate what's happening in the industry with respect to these business models. And I'm going to use two indices as an example here. So TSIA has multiple indices or indexes, as some people like to call them. One is Technology and Service 50, which is 50 of the largest technology and service companies on the planet. A few example logos here that are in that index. And then there's another one called the Cloud 40, which is 40 public companies that are fully operating in as-a-service business model. In fact, they're all pretty much software, right? So some of them are maybe platforms, infrastructure, or software as a service, so all software. And you'll see a few examples of the logos that are in that index. So these two groups exhibit quite a different profile. So taking a look at the first group, right? These would be companies that have been around 10, 15, 20 years or so. What you see is that their growth rate as a collective group is flat to down, right? Many of them back in the 90s, maybe some of them even around in the 80s, you would have seen 20, 30% growth there. Now you're seeing, single digits. And 15% operating income or net profit would seem pretty decent. But it's actually not when you consider that when they were up and coming in the 80s and the 90s and in the early 2000s, those numbers were around 20%, 25%, even 30, and even 35%. Right? And the market really rewarded them very, very heavily for that. So that profitability is coming down. And it's coming down because the technology that they're putting out there is pretty much being commoditized today. This is not about the technology, it's about the outcome from, and the value and the outcome from the technology. So when we take a look at their revenue picture, what you're seeing here is the orange line is what we'll call the technology and product license revenue, right? In about 2012, 2013, that started to drop below the service revenue line. And service revenue will be anything that's a subscription as a service, perhaps your support annuities, maybe some managed services, whatever a professional service, even some project-based services, but mostly recurring services, right, started to take off. And we don't anticipate that those two lines are ever going to come back and meet again. That horse has left the barn for sure. Now, but the bad news about this, so you see the product revenue, first of all, negative 3.4% last quarter, but it's pretty profitable. I sell a piece of technology, I take a nice big chunk of money off the table from the customer, and then I sell a really highly profitable support contract. Right? That's actually, support contracts are a very highly profitable piece of the business. On the other hand, service revenue is up 12.9%, but it's very unprofitable. So that's what's putting a lot of the pressure on both the top line and the bottom line. So in B2B, certainly, this model has shifted from IT buys and owns a complex product to a business buyer who wants to consume a simple service. Right? So it used to be IT would buy all of this stuff, and their raison d'etre was to go stand it up and implement it and so forth. And so what's happening in the business model here? So let's just walk through the impact of that on businesses. So the good news for the customer is it's getting simpler. The bad news for the vendor, it's getting more complex. So that complexity has has been absorbed by the vendor, us all. If we've been in companies that have been around for X years, how many of you sort of are pivoting to as a service or have at least introduced some subscription-based product if your company has been around for a number of years? Right, a few of you. Yeah, more. So you've taken that complexity off the table. And what has that done? That's added cost to your P&L. You've taken on hosting costs. You've probably included basic support in that subscription, whereas previously you used to monetize that in the form of a support contract. You've probably invested in, even free professional services to get the customer up and running. Maybe you stood up a customer success function. Anybody got customer success? Yeah, a lot of you, right? And many companies are not monetizing that customer success function, so it's an added cost. And then, on top of that, your sales model is probably similar to what it used to be, except now you're taking less revenue from the customer. Because you're not getting, let's say, a $1,000 perpetual license, you're getting maybe $200 subscription in the same time frame. So your sales costs relative to your revenue have gone up, and your price per unit that you're seeing has gone down. Significant pressure. So what we see in these subscription models is the top line growth is pretty awesome, 25%, and these are Q4 2019 numbers. But the profitability, -4. And -4 is actually good because even 2 years ago, 3 years ago, that number was -15. So it's improving, but it's still highly unprofitable. And even more to that, while that 25% is really, really high, and that's really great because the stock market is rewarding high growth on the top line for most as-a-service businesses. What you're looking at here is the reason it's high and the reason it's good is that companies are investing in it. So what you're looking at here is sales and marketing spend compared to revenue. Now, if the industry had figured out, a new model for subscription businesses, for getting marketing and sales to align with predictable revenue growth, you'd see those two lines being a bit more parallel, right? But they're not. So it's unpredictable. And if you're wondering which company is spending over 80% of their revenue on marketing and sales, that would be Nutanix, if anybody knows Nutanix. I don't have their logo up there right now. Okay. So in summary, I'll just build this out. In summary, the most common reasons for lack of profits in any kind of as-a-service business model is you've got the traditional sales model, you've got marketing spending more time, still a lot of time on landing new customers, when we all know in subscriptions that most of the revenue comes after the first sale, right, in the form of renewal and growth, but that model is still there. Commoditized, so many companies have taken feature function and just applied a subscription price point to it, right? And not thought through what is the new value proposition of that as-a-service offer. And again, embedded support, non-monetized customer success, and professional services. So it's tough. It's tough for the businesses. In fact, 80% of all subscription businesses are operating unprofitably today. There's been well quoted within the venture community that, as we know, in startup world, 90% of all startups will be unsuccessful and will fail, even though they have high revenue growth and they're venture-backed. And in fact, looking at history, if we look at that TNS 50 index, we started it about 12 years ago. There's only 22 out of the 50 companies that are still trading publicly in that index. They've either gone out of business, they've been taken private by private equity so that out of the public eye, they can try to figure out how to transform themselves, or they've been acquired, having run into some challenges with profitability. So there's a lot of very significant headroom. So what can we do about this? Well, how can we, of those of us who are in subscription models, born in the cloud companies, or companies pivoting to that, how do we increase our odds of success? So as a company, we have looked at this. We've sort of looked at what are all of the different practices that are really associated with what we will call pace setters, people who have actually been successful. I'll name a few. Microsoft has done an amazing pivot to as a service. Autodesk is another company that's done a pretty amazing pivot to as a service. Salesforce is now operating profitably. Do you know how many years it took Salesforce to deliver a bottom line profit? They were founded in 1999. I was with them in 2006 after an acquisition, and expected that they'd be turning a profit any day. How many years, does anyone want to venture a guess how many years it took Salesforce.com to turn a profit? 5? 10? 16? 19 years. Yeah. So right at the end of fiscal 2018, they turned a profit. And so that might be a surprise to everybody. But, you know, the market rewarded that top line growth. And they were able to do some pretty amazing things. They're doing some of the, when we look at what they're doing today, and they're a member, they're a client of ours, but when we look at what they're doing today, they're starting to really double down on some of the, what we'll call pace setter practices for growth and profit. So let's take a quick look at that. There are a series of maturity markers on that journey from where services, let's say, supports the technology, to a place where the technology fuels the service, right? And that's a way to sort of think about the traditional world and the as-a-service world. And if we look at a maturity framework that just says, okay, you're operating in a traditional transactional way, where you sell to your customer and then you move on to the next thing, right? Where you're experimenting with as-a-service, you're getting effective with it, and you're efficient with it. And when we look at those, what are the markers, it's very, very consistent across the industry. So folks who are experimenting are really delivering subscriptions with embedded support. Now, most as-a-service company or SaaS companies start here, right? They put a subscription out into the marketplace, they embed support. It's very undiversified revenue streams, and it's highly unprofitable. Now, you could say, well, that's part of their strategy. They've got venture backing. They're investing in their growth. And that's true. That's true. But we also see that once companies hit about 100 million or so, they really start to get more holistic in how they think about the customer journey, how they put together products, services, data, analytics in a way that helps the customer move along the journey, and they also have a way to build out a portfolio that monetizes all of that. So we start to see them moving into the effective stage. And then ultimately in efficient, we start to see things like vertical segmentation, getting really that tighter product market fit or offer market fit, making the value they deliver really, really tangible so it's measurable at the time of renewal. So you can not only say, here's my value proposition, I promise, Mr. Customer, you're going to realize, but then at the time of renewal, actually having the ability to be able to prove that, right, through measurement. And then with great value propositions, the prospect of engaging in value-based pricing puts a whole bunch of money to the bottom line. So we start to see scale and profit really coming in there. So this is where, through all the data that we've analyzed and working with all the clients across the technology industry, this is roughly where the industry is sitting today. Is that a surprise to anybody? You're still awake? So obviously, SaaS companies and other as-a-service companies are a little bit over to the right. Traditional companies, obviously, a little bit behind. But on average, we're still very much in that experimental phase when it comes to really, as an industry, having the business model engine working in a way that's going to deliver top line growth and bottom line profits. And the reason why I'm sharing all of this, there's two reasons. Number one, as product managers, we are, right, the proxy for the business. Our goal is to put products into the market that have a value proposition and then figure out how to monetize that value. I mean, that's ultimately, and to deliver great experiences for our customers in the process. We can't get, as an industry, over to the right here without effective product management practices and operating in a way, in a series of ways that actually start to move that needle. So I'm going to talk about that in the few minutes I have left here. And why do we care? Well, when we look at the data on where the bonuses come from, how many of you get your bonus when revenue grows? Yeah? How many of you have goals around profitability or margins of any kind? Yeah, a few. So maybe that's reflective of these numbers here. Well, this is why we care, right? We've got goals, we've got bonuses. We are a proxy for the business and the epicenter of impact within our companies. So this is our challenge. This is our challenge as a collective group. Now, I'm not going to go through all of this. You say, thank God, because it's like late in the afternoon, I can't handle it. But this is the formula for ARR, annual recurring revenue, which we all know is really, really important, right? There's lots of puts and takes. There's retention and churn and pricing and upsell and cross-sell and whatnot. And I test regularly, what is the proficiency, what's the fluency for the formula for ARR across the product management community, right? Somebody who could walk up to a whiteboard and say, oh, sure, I can explain ARR and literally, map this out, formulas and all, calculations and all. What would you say is the percentage of product managers and product management groups and leaders who could teach the class on that formula? Any guesses what the data says? I think I heard 10%, 5%, 3%. Well, that's really interesting that you all say that, because the most recent number that I have at least says 9%. And that's up from the data I had at 5% about 18 months ago. So I would submit to you that how on earth can we build solutions for our companies who are in a recurring revenue model if we don't understand at an intimate level how our companies make revenue? So I think it's our responsibility to figure that out. And I think that and you'll see that there are specific product things that we can do to influence every step along that way. So, I'm going to speed up a little here. So profitable ARR growth is accelerated by, when we think about this formula, after your core strategy, right? You have your core strategy, and we don't want strategy debt, as we heard early on, right? But establishing that the formula is accelerated by having a tight offer market fit. And I say offer market as opposed to product market because it's technology, services, data analytics, the whole picture. And designing and pricing our as-a-service offers to do three things. Deliver customer value and outcomes, help them realize those outcomes and realize value. That's sort of obvious, feels obvious, right? Second one is optimizing the revenue capture every step along that, what we would call that revenue waterfall of ARR. And designing and pricing offers that really keep in mind make sure that it's designed to deliver a cost-effective customer engagement model. So cost-effective way of selling, we heard about the high cost of sales. A cost of support, we heard about the high services. Customer success, anybody who's engaging in that engagement model, the product can actually make a really, really big difference in how that's done. So really a quick comment on each of these. Some to-dos, some takeaways here, making that value proposition highly tangible. These are ways that you can really significantly move the needle for the customer, making it tangible so you're not only promising it, but you're actually proving it in a tangible way at the time of renewal. Prescriptively engineering adoption, I know you've all probably thought a lot about that. And measuring and optimize not only your first time to value, which we all know is correlated with adoption and renewal, but multiple value moments along the way. And those will drive the metrics, the leading metrics in the right direction. On optimizing revenue capture, number one, let's move that 9% up into double digits. Because if you understand that you can actually, you can actually design products that can influence every step along the way. You can engage in price, if your value proposition is tangible and you have an ROI associated with it, it becomes much easier to convince your customer that the price that you're asking, the value-based price that you want to command for that, is actually viable. And then, of course, product qualified leads, analytics qualified leads to advise the sales process and the customer engagement process. Cost-effective customer engagement. There's a number of practices here. Deeply embedding serviceability, self-healing products, remote serviceability, intelligent search, all the things that you can do to keep that experience immersive and prevent customers from having to go somewhere else when they run into a roadblock of any kind. And then finally, those complete offers, again, I'm going to repeat it, technology, services, data, and analytics, holistic to drive the customer journey, not only for your direct sales team, but for any of your e-commerce initiatives or any of your channel partners. And iterate and measure all of it. You've got the lagging metrics, you can influence those leading metrics. So we can solve for this. We can solve for this. I named a few companies that are doing some pretty amazing things with their offers, with their pricing, with their value propositions, with their life cycle management process that is really geared to directly accommodate as a service. Some assets that speak to these topics quite specifically. You can shoot me an email or hit me up on one of the breaks. Happy to share copies of these with you if you're interested. So, thank you for your time.